This week's key macro question is it safe to buy the dip in risk assets? Our answers are from a purely data driven perspective, not much has changed with respect to our sanguine growth, inflation, and policy outlooks in the US economy. As such, we must look abroad for context clues. We expect the BOJ to continue normalizing Japanese monetary policy in the coming months, likely faster than consensus expects. That is bearish. We expect an acceleration in policy support in the Chinese economy in the coming months, likely more than consensus expects. That is bullish. Overall, we continue to find it difficult to articulate a defensible bear case at the current juncture, which implies the path of least resistance for stocks and other risk assets is likely higher over the medium term as global liquidity meanders higher. We currently see the first half of 2025 as the earliest period in which investors are likely forced to risk manage trending market volatility. Trust that we will communicate effectively if and when that changes.
This week's key macro questions are: is the coast clear for stocks and other risk assets to rally sharply into year end? And will the BOJ throw cold water on a year end rally? Our answers are: the Fed's latest dot plot did exactly what asset markets required it to do, which is pull forward rate cuts from 2026 and 2027 into 2024 and 2025. We've been among the most vocal investors across global Wall Street in calling for bonds to underperform stocks as a result of the Fed supporting our call for nominal GDP to surprise to the upside over the medium term. So far, so good. The BOJ used its forward guidance function to dramatically reduce the risk of further policy normalization over the short to medium term. As such, we do not see the BOJ hiking at either its October 31st or December 19th meetings. Much like with the Bank of England's dovish response to the UK gilt crisis in the fall of 2022, or the Fed's dovish response to the regional banking crisis in the spring of 2023, or the Fed's decision to plunge into a rate cutting cycle with core PCE tracking 30% higher than their 2% target, we continue to observe evidence of central banks around the world exalting financial stability over price stability. That is a structurally bullish dynamic for risk assets. Also bullish is our expectation for both US and global liquidity to accelerate markedly throughout 2025, the former due to TGA spin down post the January 1st lapse of the debt ceiling moratorium, and the latter due to a weak dollar facilitating greater stimulus in China, increased cross-border financing, and global dollar recycling from accelerating trade flows. The positioning cycle and a high risk of social unrest in the US following the election are the only things standing in the way of S&P 500 6,000 by year end. In terms of our KISS portfolio construction pivots, no pivots today. KISS, we did have a pivot on Tuesday, so make sure you caught that intra-week update on Tuesday ahead of the Fed meeting. KISS is currently at 40% cash, 30% stocks, 30% fixed income, and 0% Bitcoin. So obviously we're fundamentally bullish, have been fundamentally bullish, every day since November 2nd. And so we continue to expect that KISS over time will continue to increase its allocations to stocks and Bitcoin, and may reduce its allocation to fixed income if we're right on our fundamental views. And if we're wrong on our fundamental views, then KISS will do exactly what it's designed to do, which is minimize downside risk in a bear market.